For the past 2 years, investors have been obsessed with a handful of artificial intelligence winners while quietly abandoning one of the most profitable areas of the technology sector. Many software companies that once traded at premium valuations have either moved sideways or declined significantly, even as major stock indexes continued pushing higher. The popular explanation is simple. Artificial intelligence is expected to make software easier to build, increase competition, and eventually reduce the pricing power that software companies have enjoyed for decades. It is a convincing story, and because it sounds convincing, billions of dollars have been invested based on that assumption. But markets often become dangerous when a narrative becomes too popular, and that is exactly why I believe investors should pay attention to what is happening inside the software sector today. The first thing to understand is that stock prices are driven not only by fundamentals but also by positioning. Most investors spend their time analyzing earnings reports, revenue growth, and economic forecasts, yet they ignore where the money is actually positioned. When large hedge funds, institutional investors, and professional traders all crowd into the same trade, the market eventually reaches a point where there are few new participants left to push that trade further. In the software sector, years of negative sentiment have encouraged investors to avoid or short many companies. This means a tremendous amount of pessimism has already been priced into these stocks. The question is no longer whether artificial intelligence will affect software. The question is whether the market has already discounted that risk to such an extreme degree that even modestly positive developments could trigger a powerful reversal. Short selling creates the unique dynamic that most retail investors fail to appreciate. When an investor buys a stock, the maximum loss is limited to the amount invested. But when an investor shorts a stock, the potential losses are theoretically unlimited because a stock can continue rising indefinitely. As a result, short sellers operate under constant pressure. If prices begin moving higher, losses accumulate rapidly. Risk managers become concerned, margin requirements increase, and traders are often forced to reduce their exposure. The only way to close a short position is to buy back the shares that were previously sold. This buying activity creates additional demand, which pushes prices even higher, places more pressure on the remaining short sellers. This process can become self-reinforcing. A stock rises slightly, some short sellers cover their positions, and their buying pushes the stock higher. That higher price causes additional short sellers to experience losses, leading them to cover as well. More buying follows, creating further gains. What began as a normal rally can evolve into a powerful upward move, driven almost entirely by positioning. History is filled with examples where heavily shorted sectors or companies dramatically outperformed expectations because investors underestimated the impact of forced buying. The software sector today possesses many of the same characteristics that have preceded major reversals in the past. Another reason this setup deserves attention is the changing macroeconomic environment. During the early stages of the artificial intelligence boom, investors were willing to pay almost any price for companies perceived to be at the center of the AI revolution. Capital flowed aggressively into semiconductor manufacturers, data center operators, and AI infrastructure providers. Meanwhile, traditional software companies were treated as potential victims of technological disruption. However, as interest rates remain elevated and economic conditions become more uncertain, investors are becoming increasingly selective. The market is beginning to focus less on distant promises and more on businesses that generate consistent cash flow, recurring revenue, and sustainable profits. Many software companies fit that description perfectly. One of the biggest flaws in the bearish software narrative is the assumption that creating software and distributing software are the same thing. Artificial intelligence may dramatically reduce the cost of writing code, but that does not automatically eliminate the advantages held by established software companies. Enterprise software businesses are not valuable simply because they produce code. They are valuable because they have built relationships with thousands of customers, integrated deeply into corporate workflows, and created ecosystems that organizations depend on every day. Replacing a mission-critical software platform can be expensive, disruptive, and risky. As a result, many customers continue using existing solutions even when alternatives become available. This reality becomes especially important when evaluating how businesses actually make purchasing decisions. Large corporations do not change software providers every time a cheaper option appears. They prioritize reliability, security, compliance, customer support, and integration with existing systems. A company that has spent years building its operations around a specific software platform is unlikely to abandon it simply because a new competitor enters the market. These switching costs create a level of protection that many investors underestimate. As artificial intelligence becomes more widespread, established software companies may actually strengthen their positions by incorporating AI tools into products that customers already use and trust. The market appears to be slowly recognizing this possibility. While headlines continue focusing on the most popular AI names, several software companies have begun showing signs of stabilization. Their stock prices are forming higher lows, trading volumes are improving, and institutional ownership remains strong. These developments do not guarantee a major rally, but they suggest that selling pressure may be losing momentum. When a sector has spent years underperforming, even small improvements in sentiment can produce meaningful price movements because expectations have become so low. Investors should also pay close attention to the options market. Professional traders often use call options to gain leveraged exposure to potential upside while limiting their downside risk. Unusual increases in call option activity can sometimes indicate that sophisticated investors are positioning for a future move before it becomes obvious in the stock price itself. Combined with declining short interest and improving technical patterns, options activity can provide valuable clues regarding whether a sector rotation is beginning to develop. The broader lesson extends beyond software itself. Markets move in cycles. Capital constantly rotates between sectors, industries, and themes. The companies and sectors that dominate one period often struggle during the next, while neglected areas eventually attract attention again. Successful investors understand that opportunities frequently emerge where sentiment is most negative. When expectations become excessively pessimistic, the potential for positive surprises increases dramatically. This does not mean every software company will succeed, nor does it mean artificial intelligence will fail to disrupt certain businesses. It simply means the market may have become too confident in one particular outcome. At the heart of this thesis is a simple principle. Markets are forward-looking mechanisms. By the time a narrative becomes universally accepted, it is often already reflected in prices. The software sector has spent years being treated as a loser in the AI era. Investors have sold shares, opened short positions, and reduced exposure based on fears of disruption. Yet if actual business results turn out to be better than those fears suggest, the reversal could be significant. The combination of low expectations, heavy short interest, improving fundamentals, and changing macroeconomic conditions creates a setup that deserves serious attention. The most important thing to remember is that major market moves rarely announce themselves in advance. By the time headlines declare that software is outperforming again, much of the initial opportunity may already be gone. The early stages of a reversal often appear uncomfortable because they occur while skepticism remains widespread. Investors continue focusing on old narratives even as the underlying market structure begins changing. Those who understand positioning recognize these shifts before they become obvious. Whether the trigger comes from earnings reports, economic data, changing interest rate expectations, or simply improving sentiment, the ingredients for a substantial software rally are already present. Years of underperformance have compressed valuations. Heavy short positioning has created latent buying pressure. Investors are beginning to question whether the market's fears regarding artificial intelligence have been exaggerated. If that reassessment continues, the software sector could transition from one of the market's most ignored groups to one of its strongest performers, not because the industry suddenly changed overnight, but because extreme pessimism eventually reaches a point where the risks become smaller than the opportunities. That is why the next major surprise in the market may not come from the stocks everyone is already talking about. It may come from the sector that investors spent the last 2 years betting against. The spring has been compressed for a long time. Expectations remain low. Positioning remains crowded. And when those conditions begin reversing, the move can happen much faster and much more powerfully than most market participants expect.